At the end of the last lecture, we were right here looking at these two equations. It has to do with risk premium. So the return on a given asset is the risk-free rate plus some risk premium, which we break up into the liquidity risk premium, the default risk premium, and the market risk premium. I'm sorry, the maturity risk premium. What is those three? The liquidity risk premium refers to a risk from how easy it is to sell a security. So there's some assets that are really easy to buy and sell very quickly. For example, stocks are actually pretty easy to buy and sell quickly. You can buy a share of Microsoft at noon and sell it at 12:01 if you want to. A lot of day traders do things like that. That's a very risky business, but that's very liquid. Take for the opposite example, real estate is very non-liquid. Excuse me. If you buy a house, it might take you 6 months or more to sell it. So if you have a liquid asset, it by definition has a lower liquidity risk premium and it will require less return. Illiquid assets require higher return. If you have a large market available to you to buy and sell your security, it's going to sell for a higher price, which means its required return is going to be lower. Default risk premium refers to the odds that you don't get paid back what you expected to get paid back, meaning we usually think of it in terms of debt instruments, so in terms of like corporate bonds. Corporate bonds are rated from AAA, AA, single A, triple B, double B, B, C, and so forth in terms of their probability of getting paid back. So there's three rating agencies, Moody's, Fitch, S&P, and they rate bonds in terms of the likelihood that they're actually going to pay back their debt obligations like they said they were going to pay them back. If you buy a bond that's lower rated, meaning AAA corporate bonds, we usually think are actually as good as government bonds. In fact, some people would say even if the government went bankrupt, there are certain corporations that would still keep paying on their debts, meaning they actually have better credit ratings than the government does. And that's probably true, I would think. But as you move down from AAA, and there's a very small handful of companies that are AAA rated, on the order of 5 to 10, and that's it. And after 2008, it went down to below 5, I think. So there's not that many AAA rated corporate bonds. So once you get below that, it goes as a rating, meaning these rating agencies rate corporate bonds based on the probability they're going to pay back. As you get lower rating, there's a bigger probability you're going to default, not be able to pay on your bonds. Maturity risk premium, MRP, refers to the fact that longer-term debt usually requires a higher return than short-term debt. And there's a reason for that, which we'll talk about in a second. Let's go through each one of these and let's look at a little bit of historical data, and then we'll talk a little bit more in depth. Alright, first off, I have a chart here that shows the rates on U.S. government bonds. That's the blue line. That's the lowest rate. Again, these are interest rates on the left-hand axis. They're in terms of decimals, so when you see 0.06, 0.04, that's 4 and 6%. The blue line's the lowest because we think the government's the lowest risk investment, and you see that bear out in terms of actual interest rates. The red line is the rate on the average AAA rated corporate bond. Again, I just mentioned most people think AAA corporate bonds are just as risk-free as U.S. government bonds. So the question arises, how come there's a risk premium? If you look at the red line, it's always above the blue line. Why are they requiring a higher return from AAA rated bonds than they are from the government? These AAA rated bonds are not nearly as widely traded as government bonds. Government bonds trade, they have a very, very liquid market. The government has set up a set of dealers that market makers that constantly buy and sell their debt, meaning There's always somebody willing to buy and sell U.S. government debt. It's not necessarily true of a AAA rated bonds. Most bonds, when they're issued, trade a whole lot when they're first issued and trade a whole lot right before they expire. In the medium term, between when they're issued and when they expire, they don't trade that much, meaning they don't have near as much liquidity. So when you buy a 30-year government bond, or I'm sorry, a 30-year corporate bond from Coca-Cola, for example, you might not be able to find a buyer for that. You can find a buyer, but you're going to have to take a hit when you sell it. You're going to have to sell it for less than maybe you think it's worth, because there aren't that many buyers out there at any given point in time. And so the difference between the red line and blue line, the typical interpretation of these two lines is it's due to liquidity. People think AAA, if you're a AAA rated corporation, by definition, Fitch, S&P, Moody's, they say there's no chance of you ever defaulting at all. Meaning, even if the economy does something that we don't even expect, that we don't see on the horizon, meaning the economy turns somewhere bad that we don't even foresee as possible, they will still be able to pay on their debt. So why is there a premium paid on AAA corporate debt over government bonds? Well, it's liquidity premium. So one way to measure the liquidity premium is to look at the difference between AAA corporate debt and government bonds. So let's do that real quick. Click on my chart here. Move this over, and I have a column set up that's AAA debt minus risk-free, and we're going to call that the liquidity premium. So this is the difference between AAA rated corporate bonds and government bonds, which we consider the risk-free rate around here. This is a measure of the liquidity risk premium, which is one thing that moves interest rates, which is there's certain times when people don't mind holding illiquid securities, and there's certain times where people, like right here, don't want to hold illiquid securities because they don't know what's going to happen next day. There's two types of risks. Well, there's two types of ways to define risk. One is definable risks. All the risks we've talked about earlier, this is not a risk management class, so I'm not going to go way in depth here. But we've defined different types of risks: political risk, maturity risk, liquidity risk, default risk. There's a whole nother type of risk that's a completely different category, and that's undefinable risk. It's uncertainty is what we'd call it, which is we don't know what the next day's risk is going to be. Meaning something could happen tomorrow that there's no way we could forecast at all. So we can't put a dollar value on it if we don't know it exists. When that happens, when that enters into the market, we really like to hold securities that we know we can get rid of tomorrow if we have to. And so illiquid securities like corporate bonds will have a risk premium built in, like they did starting in 2007. Notice the true crisis didn't happen until October 2008, right here. But there was an illiquidity risk premium started to build in the early 2007. And you can see that in all markets, actually. That early 2007 is really when the crisis began. And you can see that by watching interest rates. That's the point of watching these interest rates. So you have information available to you to help you invest better. Same thing happened in 2000s. What happened right here? Well, we had September 11th. We had Enron. We had a whole lot of things happened right here. What did we have over here? We had long-term capital management went bankrupt. If you don't know the history of that, you can go look it up, where a very gigantic hedge fund went bankrupt investing in lots of different debt around the world. The big one that got them in trouble was they invested in Russian government debt, and they defaulted, which a lot of people thought would never happen. But this is called the liquidity risk premium. This is one way to measure the liquidity risk premium. which is how much do we care about holding an asset that we know we can trade second by second, minute by minute, versus how much do we want to hold an asset that we might only be able to trade if we can find a buyer. Alright, now let's go back and look at the difference between AAA rated debt and BB rated debt. Triple B rated debt is the cutoff between what we call investment grade and junk bonds, or junk debt. Junk is kind of a harsh word, but it basically means there's certain laws in the U.S. that certain companies, like insurance companies and stuff, and banks can only invest. Well, banks can't invest in corporate debt at all, but insurance companies and certain investment companies can only hold what's called investment grade debt. So once you get below triple B rated, you're considered junk. You're not investment grade. And there's a whole bunch of companies out there that can't invest in you. The B line here, double B, the red line, is non-investment grade debt. That's a double B. So the difference between the blue line and the red line would be what we'd call the default risk premium, which is the risk that, again, the B line, AAA rated, when the rating companies call you AAA rated, they basically think there's no chance of you ever having a default. So that's only a very small handful of companies like Coca-Cola and companies like that they think never will go bankrupt, no matter what. So I've compared that against companies that they think we don't necessarily know. They could go bankrupt, but they're kind of in the middle ground. So we have the average double B rated company, which is that flip from investment grade to non-investment grade, and the AAA rated corporations. The difference between these two we usually think as being the default risk premium, which it's not the default risk premium, but it's a proxy for the default risk premium. The nice thing about having very active markets like we do in the US is you always have a lot of information. So this gives you information about the default risk premium. What is the default risk premium? What is the risk of holding a risky company? You'd love to buy this company right there, right? If you were buying, say, an average company on the red line, right there you're going to get a 15% return on your investment. That's great. But how do we know that's not going to go higher, right? The point is you have to look at the risk and the return in terms of context. You're always taking more risk, more return in terms of more risk. So if you're taking a triple B rated company right there, what is that compared to a non-risky corporation? That's what you really want to know. So let's look at those two compared to each other. This line here tells you the double B rated companies versus the AAA rated companies. Gives you a measure of the default risk premium over time. So you can see where risk picked up after the recession we had here in the US in the late 2000s, how it came down during the economic recovery, and then how it spread back up starting in early 2000 and then really spiking in October 2008, and then how it's come back down. Alright, next we're going to look at, with as much time as we have, let's look at the term structure. We'll do this real quick. Let me start by showing you a chart of long-term interest rates. Here's what I have. Try to make this a little bit bigger. This shows you a chart of interest rates on U.S. government bonds. Looking at my time, I'm going to run out of time. So I'm going to pause this and we'll come back to it on the next video. Thanks.